Hi, everyone. It's Peter Schiff. This is Friday, November 2nd, 2011. Well, today we got the highly anticipated jobs report for August, or should I say lack of jobs, which is more descriptive of what actually happened. The government reported that 0 jobs were created last month. And in fact, I'm sure by the time we get around to revising the numbers down, which is typically what we do. In fact, this month they also revised downward last month. I'm sure we're going to find out that we actually lost jobs during the month of August. Now, of course, President Obama is getting ready next weekend to make, or over the weekend, I think, to make a speech about how he is going to create jobs. And, you know, there's that old definition of insanity, you know, doing the same thing over and over again and expecting a different result. Well, what is Obama likely to propose? More of the same failed policies, more government stimulus, government spending, gimmicks and credits designed to stimulate employment. But the bottom line is none of it has worked. I mean, if deficit spending created jobs, we'd have full employment right now. It doesn't work. In fact, unfortunately, I think the argument between stimulus and deficit reduction is going to be won in favor of stimulus, because people are of the impression that there's a trade-off between deficit reduction and job creation, as if they're mutually exclusive. The problem is one of the main reasons that we can't create jobs is because of the deficits. The government is borrowing so much money that otherwise would have been available for the private sector to use to create jobs and make the investments necessary to provide workers with the tools and the equipment that they need. But instead that money is financing government spending, or it's financing the real estate market, or student loans, or wherever it's being directed by government, but it's not going to job creation. But I think what's going to happen is we're going to get bigger deficits in the name of job creation, and we're going to destroy even more jobs. But you know what President Obama should really be doing? Instead of trying to focus on how to create jobs, how about not destroying the jobs that we already have? I mean, the Obama administration has waged war on employers. In fact, I wrote a commentary today labeling Obama as the job destroyer in chief. In fact, if you want to have a perfect example of the war on employers, listen to the interview that I did on Schiff Radio. It's up on my YouTube channel at Schiff Report with the CEO of Gibson Guitar, and how the government is trying to destroy the 1,200 good quality manufacturing jobs at this iconic American company. So, number one, stop destroying jobs, and number two, let the private sector create jobs. But in order to do that, we need to get the government out of the way. We need to reduce government spending, and we actually need higher interest rates. We need to stop siphoning money away from Main Street to Wall Street. We have to replenish our savings so that we can make the investments necessary to create jobs. Because right now, 0% interest rates, capital is fleeing the U.S. Why would you want to invest here when your money is being debased, when you can't get a return? So we're chasing capital away, which is the exact opposite of what we want. Now, looking at how the markets reacted, Dow Jones down about 250 points on the weaker than expected jobs numbers. Bonds, of course, went the other way. Bonds went up. The yield on the 10-year, I believe it actually closed below 2%. That is the lowest yield yet. Why anybody would want to loan money to the U.S. government for 10 years at 2% is beyond me. But you know what? Apparently Bill Gross now wants to do it. And this maybe is one of the biggest capitulations ever, which could be a sign that the bond bubble is about to burst. Remember, Bill Gross of PINCO made the news about a year ago when he announced that he was going to stop buying treasuries. In fact, he had sold all of his treasuries. Now, the reason he did that, and he now admits that he made a mistake, the reason he sold treasuries is he believed the U.S. economy was going to recover. And he thought a recovering U.S. economy would mean higher rates, which is why he wanted out of treasuries. Well, the reason he now wants back in, despite the fact that the yields are even lower and the prices are higher than when he got out, is because now he's convinced that there is no recovery, and so he wants to be in bonds. Now, he's got a key thing wrong here. You see, I've been advising people to stay away from bonds for a long time, but not because I thought the economy was to recover the way Bill Gross does, but because I knew it would never recover. And I know that a weak economy is ultimately bad for bonds, because as the economy is weaker, That means more stimulus, more quantitative easing, more money printing. So since I know the Fed is going to continuously try to stimulate a weak economy, and since I know the more they stimulate it, the weaker it's going to get, ultimately they're going to destroy the value of the dollar, which is all bonds are with their future promises to pay dollars. So ultimately, everything that we're doing to stimulate the weak economy is going to destroy the value of bonds. And maybe this major capitulation by the biggest bond buyer of them all outside of the Treasury or maybe some foreign central banks, but certainly in the private sector, the biggest bond buyer, maybe this is evidence that we're nearing a top if we're not there yet. I mean, it's a pretty good evidence. But, one market that clearly is not a top, in my opinion, is the gold market. Let's talk about gold. Gold was up about $50 today. It's not a new record high. It's still maybe about 20, $30 off the record. But we've recouped almost all of that big decline that we had when gold went up to about 1,900 very quickly, dropped down to about 1,650. We're now back up, around 1,870 or something like that. But gold is far from a bubble. Now, we had all sorts of talk in the last couple of weeks about the bond bubble. In fact, Dennis Gartman called the top of the market. He actually said that the biggest bubble of our lifetime had burst. The biggest bubble of our lifetime? I mean, maybe if somebody was just born, but for anybody that's been around for at least a decade, what about the Nasdaq bubble? What about the housing bubble? I mean, those were much bigger than what we've had in gold. And as far as I'm concerned, we don't even have a gold bubble. I mean, at least not yet. I mean, one day there may be a bubble in gold, but clearly we don't have one now. But Dennis Gartman was calling the top, which of course it's not the first time he's done that. He's called the top before with the same kind of, the trade is too crowded, there's too many bulls. And so he's out there on television calling it top. But, one of the most ridiculous observations that Dennis Gartman made as evidence of a top is he said that the value of the gold ETF GLD was larger than the value of an index that tracked the S&P 500. And this, according to Dennis Gartman, represented some kind of insanity where gold was being valued higher than the stock market. He compared it to the bubble in Japanese real estate, where at one point the emperor's palace in Japan was worth more than the entire state of California. But the problem with Dennis Gartman's observation is that it's completely meaningless, because he's simply looking at one way to buy gold and one way to buy stocks. The fact that that particular ETF had a larger market cap than that particular stock market ETF is meaningless, because most people who own stocks don't do it through that ETF. If you looked at all the entire value of the U.S. stock market, which would be all the mutual funds that own U.S. stocks and all the individual stocks, the size of the stock market dwarfs the size of the gold market. I mean, it's not even close. So the whole observation is ridiculous. Rather than a blow-off top, which is what Dennis Gartman thinks he saw, what I saw is a breakout. I saw a channel, an upward-moving channel in the gold market, and we broke out of the upper end. Far from being bearish, the price action was very bullish. And in fact, what I think is even more bullish, and I have been forecasting this all week on my radio show at schiffradio.com, but it finally happened today, is the Huey, the gold and silver index, actually broke out to a new all-time record high. All-time record high today. Gold did not make a record high. Silver did not make a record high, although silver had a very, very strong day today. And what is unique about this is the first time in years that that's happened, where after a correction in both the metal and the stocks, that the stocks made a new high before the metal. Now, what that shows me is we're moving into the next leg of the gold bull market, where people are actually starting to believe in it. You see, the fact that gold stocks have underperformed the metal for the last 3 years or so reflects the fear in the market, the skepticism, the fact that people didn't believe the gold rally was for real. And so they didn't want to assign higher PEs to gold stocks because they expected the price to collapse. The fact that now there's some optimism returning to the gold market, despite all this bubble talk, shows me that fear is just beginning to give way to greed. Not rampant greed. There's not crazy speculation. Maybe we're going from fear to mild confidence. But this is a big shift, because I think this is the beginning of real money moving into the gold sector. Because thus far, it's been on the sidelines. All of this talk on the financial networks about the gold bubble has all been based about on the fact that a lot of people are talking about gold. Well, first of all, a lot of people aren't talking about it. A lot of investors are talking about it, but they're mainly talking about it because they don't own it. Most of the people who are talking about gold on television don't own any. So the key is, before you have a bubble in something, the people talking about it have to actually buy it. And in fact, it's not just investors that are going to have to be buying gold before it's a bubble. It's the average man on the street. And right now, he's not even involved in the conversation, let alone buying it. So I think it's a green light here for the gold market. I expect new highs in gold and silver, ultimately, new highs in the stock market. And I'm sure one of these days, Dennis Gartman will be back on television again, acting as if he's been with us the whole time and has been long of gold. But he is often called the top. And if anything, he's more of a contrarian indicator when it comes to gold than a credible source on the direction of the market. Anyway, one more thing I wanted to talk about today, and it's really, I don't know if ironic is the best word, or chutzpah, or how you want to describe it, maybe insane. But apparently the government is now going to be filing charges against the banks for bad mortgages, for loaning people money that they couldn't pay back. Which is, the ultimate in arrogance or hypocrisy. First of all, the main reason that banks lowered their lending standards was because the government pressured them to do it. Our politicians were upset that some people were being denied mortgages because they couldn't come up with a down payment, or because their credit score was too low, or they didn't have enough income. So they put pressure on the banks and Fannie and Freddie to lower their standards, which is what happened. And in fact, one of the worst things that Freddie and Fannie did was they started to guarantee adjustable rate mortgages simply based on the ability of the borrower to afford the initial payment, even if he couldn't afford the higher payments that would ultimately come when mortgage interest rates rose. So Freddie and Fannie were leading the charge, for lower lending standards, egged on by the government, pressured by the government, and other banks simply followed suit. But, even more than the hypocrisy of suing the banks for doing exactly what the government wanted is that we're suing the very banks that we bailed out. We gave them a bunch of money. The banks did what the government wanted and made stupid loans. And then when they went broke, the government came to their rescue and bailed them out. And now they're suing them to get some of their money back. How crazy is that? How about not bail them out in the first place? And here's where it even gets funnier. What if the government wins? What if they get big judgments against these banks, and now they're failing again, and they need another round of bailouts? Is the government going to give back the money they just took? Is anybody else not noticing the insanity of this, the hypocrisy? And of course, who's going to get rich on this thing? The lawyers, right? All this money is going to be transferring back and forth from the government to the banks, back to the government, back to the banks. The whole thing is crazy. But of course, the one thing you want to do, and I've been saying, is don't even buy these stocks. Don't get in bed with the government. Because I think at the end of the day, the only people who are going to make money in the financial sector are the people who work at those companies, because they keep getting lavish bonuses with the help of the Fed and the help of the government. But I don't expect the shareholders to come up with anything. In fact, they're going to be the ones left holding the bag. Anyway, that's it for today. We have a holiday weekend coming up. I have a great Labor Day weekend, everybody. And don't forget to watch the Peter Schiff Show. Now we moved to a new network. We're on Radio America. We're now heard, I believe, on almost 60 radio stations across the country, and hopefully we'll be coming to a market near you soon. Again, meantime, have a great weekend, and bye for now.